YouTube, hello, welcome back to another video. Thanks for tuning in as always. Today we've got a lovely audio setup just to improve the quality a little bit. But today we're talking about cash flow versus capital appreciation, or cash flow versus wealth creation, you could say. But we're going to be exploring the age-old debate of should you go for cheaper, lower value properties which provide a better yield or return on your money, or should you go for properties which offer better capital appreciation over 5-10 year period, but perhaps don't return as much in terms of rent. Without further ado, let's get straight into this video. Now, just to say that there are a lot of assumptions made in this video. It's for example purposes only. I would love to hear your thoughts on whether you think my examples are correct or whether you disagree. Drop them in the comments below, but let's get started. So, moving straight into this, we start on the cash flow side, and we're going to start by looking at a property of the value of £70,000, as that's very much what I'm used to looking at in the northwest of England. So if we look at a £70,000 purchase price, and we're going to be looking at a 25% deposit, as that's what potentially most people start out with. Now, when I say we're going to be making a lot of assumptions in this video, to start with, the first assumption is the fact that there are going to be no fees. So if we just take fees out of the scenario to start with, and let's start looking at the rental side of things. So if we look at the rent, and this property we're assuming we're just buying and renting straight out. Hopefully it's a 2 or 3 bed at about 70,000, and the rent is probably going to be in the region of 550, especially right now as the market is quite good and buoyant. In terms of expenses, interest only mortgage, managing agent, insurance, a bit of money put aside for maintenance, we're probably looking at about £300 per month, leaving £250 profit per month and £3,000 profit per annum. So before we move on, the other assumption of this video is a recent article that came out by Savills, which was their predictions over the next 5 years that the UK housing market is going to grow on average 21%. So that's a UK average. As you can imagine, some areas will perform better and some will perform worse. But if we take that as a UK average, 21% growth over the next 5 years, that's what we're going to apply to this example to both types of property that we're looking at. So if we take that into account, the new value for this property is going to be £84,700. Okay, so we purchased it at 70,000, 21% growth puts us at 84,700. And what I'm about to do here is refinance the property, okay? And the reason being, so we can pull money out, and I'm just showing you as an example the additional capital that this gives us, the rent this gives us, and then compare it against a property which would potentially provide more capital appreciation. So to start with, a new deposit on the higher amount of money, as when you refinance at a higher amount, you're going to have to leave in 25% still, but that's going to be higher than what you originally put in. So the new 25% deposit is £21,175. And what I'm going to do is minus the original deposit. And what this is going to do is tell me how much of that equity that's been created am I going to have to leave as additional equity in the deal. So the total is £3,665. I'm then going to look at the uplift in value, which from 70 to 84,700 is 14,000. I'm going to deduct the amount extra we've got to leave in, because that 14,700 is essentially the amount it's gone up in value. It's the capital appreciation. It's the extra equity that you've created. However, because when you refinance it, you've got to leave a bit more in, we're going to deduct that off of the price. So that's going to leave us at £11,025. And if we carry on down again, if we were to make this assumption that we had 5 properties bought at the same time, at the same value, and have all gone up the same amount, 21%, over 5 year period, we have now created an additional £55,125 in equity and capital appreciation, and essentially an extra £55,125 in wealth. Moving on down again, those rental properties would have also produced £15,000 per annum in profit, which over 5 years, over 5 properties, is £75,000, meaning in total, this property has given us back £130,000 £200,125, and that's a mixture of rental profits and capital appreciation. As I've told you already, making huge assumptions here that there's going to be no errors or maintenance things that come up with those properties, and of course that they all go up at the same value at the same time and that you purchase them at the same amount. But taking that out of the equation, let's go back up to the top before we go any further, and let's look at the higher value property. So I've taken the assumption of a £200,000 property because that's very much what I could purchase down here, down south, in comparison to a property in Liverpool, because a one-bedroom flat down where I live comes in at £200,000, and this is a property that I actually owned until recently. We lived there and we had to make the hard decision whether to keep it or sell it, and we sold it for a multitude of different reasons. But I'm going to use this property as an example because you simply can't buy properties for £70,000 down in the south. So a £200,000 property, it's a one-bedroom flat. You're going to need a £50,000 deposit to tie that purchase up. This same property is going to rent for $850. The expenses are $550. The profit is only $300, which isn't much more considering how much money you've tied up. And the profit per annum is £3,600. So interesting bit of feedback there that, yeah, this is a capital appreciation side, but as you can see, the rent isn't a huge amount more. But anyway, let's speed through this section as I've already explained it once. So the new value after the 21% growth is £242,000. The new deposit required to refinance at that level is £60,000 minus the original deposit amount gives us £10,500 that we need to deduct from the uplift in value, meaning that we've created an additional £31,500 in equity in this property, or to our wealth, you could say. And if we assume that over 5 properties, all at £200,000, all going up at the same value over 5 years, we've now created an additional £157,500, which, yeah, okay, maybe actually this is interesting, this side of things. However, let's take the rent, isn't actually that much more. So £18,000 per annum for 5 properties at that value. Over 5 years creates us a £90,000 profit in rent, giving us a total of £247,500. So given this example, compared to the cash flow example, the lower value property, you must be thinking right now, well, hang on a minute, Justin, why are you not buying these properties? This is ludicrous. You're almost missing out here on £120,000 because you're going for cheaper houses. And from looking at this as it is right now, you might think that. However, I'm about to show you the next part of this. So this is where things change a bit. As you know, each property in the lower value column cost £17,500 deposit versus the £50,000 that is required for each property in the higher value column. That means that a total to purchase 5 properties, we're going to need £87,500 in deposit money to purchase 5 properties in the lower value area. And for the higher value area, we're going to need £250,000. Well, to be quite frank, I do not have £250,000 sitting around in a bank account. If I did, no doubt I would have bought a lot of properties with it. But just saying, for the purpose of this example, now you can maybe start to see, well, £87,500 is actually quite achievable over a stretch of time versus £250,000 is perhaps a bit further to reach for most of us. Okay, so carrying on even further, and as I've said, this is where it gets incredibly interesting, because if we take this original £130,125 made and deduct the amount that we had to put into it, I mean, essentially we still have the £87,500 in our pocket because that's in equity sitting in the property. But if we assume that we've had to tie up that money, how much additional money have we made? Well, we've made £42,625 versus on the capital appreciation side, we've actually lost money. So we've tied up £250,000 to not make our £250,000 back. So that for me is where things get incredibly interesting. I still think both columns are incredibly good scenarios, and at the end of the day, I believe in property through and through. But in this example, it for me really solidifies why I went down the cash flow route, why I went for lower value properties, because I can tie up and buy 5 homes with £87,500 versus the £250,000 I would need down here to buy 5 flats. Now, there's some people out there that's going to be saying this is a ridiculous scenario and example, but I just wanted to lay out on paper exactly why I've gone down the cash flow route. And actually looking at this now, it really provides me with confidence that I'm doing the right thing. Yes, over time, more wealth would be created through buying property in areas of bigger capital appreciation. But right now, I would like to create a bit of both, but in particular, cash flow. I want cash flow into my business to help me grow the business further. And I think the scenario with the lower value property just fits what I want better. Of course, go with whatever strategy suits your personal situation better. But I think it's really interesting to consider this scenario and run the numbers with the properties that you're looking at and the areas that you're looking at. So I hope you've enjoyed this video. I hope you don't think it's ridiculous, but actually quite eye-opening. Now, if you've enjoyed this video, please give it a like. If you've got something to add, please drop it in the comments box below. It would be great to discuss it in more detail. Please share this with a friend if they need to know what the difference is between cash flow versus capital appreciation. And of course, I will see you in the next video.